Forensic read on Fathom, NASDAQ, FTHM. I did the digging so you don't have to. And yes, I judged the slide deck like a hostile shareholder. Below are 15 focused 70-word takes. Numbers first, judgment second, merciless about poor execution when it shows up. I cite a single trusted source at the end of each item. Business model. Fathom is a vertically integrated, tech-enabled real estate services platform. Brokerage, mortgage, title, and a SaaS called IntelliAgent aimed at agents. Revenue is still transaction-driven, brokerage commissions, with cross-sell ambitions, mortgage, title, SaaS. Low fixed capital intensity is attractive, but unit economics hinge on scale and agent adoption of IntelliAgent to raise revenue per transaction. Plausible model, not yet a proven, repeatable compounder. Source: Reuters. Economic moat. Fathom's claimed moat is agent network plus proprietary software. In practice, the U.S. brokerage market is fragmented and competitors replicate tech quickly. Switching costs for agents remain moderate. Local agent relationships can be sticky, but data and features aren't exclusive. The company has strategic advantages, yet no durable wide moat by Buffett standards, more tactical positioning than an enduring competitive fortress. Source: simply, WallSaint management quality. Leadership includes industry veterans and an active C-suite that has executed acquisitions and divestitures. Management has raised equity to fund growth, creating dilution. Insider buying/selling has been mixed. Execution shows competence in growing agent count, but capital allocation looks growth first rather than shareholder return first. Management is capable but unproven at converting growth into sustained owner earnings, the Buffett test that matters most. Source: Reuters revenue growth. Recent quarters show meaningful top-line momentum, mid-30s% YoY growth in recent reports, agent count increases and transaction volume expansion. TTM revenue is in the high hundreds of millions range, roughly 390 million in recent aggregations. Growth is real and measurable, but heavily cyclical and tied to housing market activity. Excellent if housing cooperates, vulnerable if rates or inventory swing the wrong way. Source: Morningstar profit margins. GAAP shows thin gross profit and persistent net losses. Recent annual revenue around 335 million with gross profit near 28 million and net losses in the tens of millions. Operating margins remain negative as SG&A, tech investment, and M&A-related costs offset revenue growth. Management cites adjusted EBITDA improvements, but GAAP margins reveal a business that hasn't yet turned scale into durable profitability. Source: Reuters earnings consistency. Fathom's earnings are uneven and loss-making across recent years. Results depend on quarter-to-quarter transaction timing, one-offs, and occasional asset sales. Analyst EPS revisions reflect that volatility. Buffett prefers predictable rising owner earnings. Fathom currently delivers episodic improvements inside an otherwise choppy trend. That makes valuation highly sensitive to timing and increases the required margin of safety for investors. Source: simply WallSaint return on equity, ROE. Trailing ROE is strongly negative, around 29% TTM, driven by cumulative GAAP losses and a modest equity base. Negative ROE means current operations are, on book metrics, destroying shareholder value. For a Buffett-style buy, you want durable double-digit ROE. Fathom must reverse losses and deliver sustained high ROE before it meets that classic quality threshold. Source: Reuters return on invested capital, ROIC. Reported ROI metrics are sharply negative. Recent snapshots show large negative percentages, meaning invested capital currently earns well below cost. That's a major red flag. Absent demonstrable excess returns from SaaS monetization or highly accretive cross-sell economics, Fathom remains a transformation candidate, not yet a capital compounder that earns returns above its cost of capital. Source: Reuters, debt levels and liquidity. Balance sheet shows modest absolute debt, low double-digit millions, and liabilities around low tens of millions. Cash has been thin, and management has used asset sales and periodic equity offerings to shore liquidity. Debt is manageable today, But dependence on capital markets and warehouse lines increases dilution and execution risk if housing revenue weakens or financing terms tighten. Source: Reuters Free Cash Flow. Operating cash flow and free cash flow have been negative recently. Operating cash outflows and negative FCF in the last reported year. Management points to adjusted EBITDA improvement, yet GAAP cash conversion lags, until Fathom consistently generates positive owner earnings and predictable free cash flow. Valuation must assume uncertainty and require a substantive margin of safety. Source: Reuters. Valuation metrics. Market capitalization is small, low tens of millions, with very low price to sales, PS 0.1, 0.15, and price to book around a 1.3. PE is not meaningful due to losses. The market is pricing execution and cash flow risk into a cheap multiple. Cheapness alone isn't a Buffett buy. Price must buy predictable owner earnings, which this company has not yet demonstrated. Source: Simply Walsane Intrinsic Value Estimate, Scenario Summary. Using VAR 28/15 net shares and conservative DCF scenarios, discount 12%, terminal growth 3%. A moderate recovery, FCF ramp to about 15 million by year 5, implies intrinsic roughly 4.445 per share. An optimistic path, faster FCF ramp to 30 million, implies about 8.9, 9.0 share. If FCF never turns positive, intrinsic approaches 0. These figures are highly sensitive to timing, margins, and reinvestment needs. Source: Reuters Dividend Policy. No dividend exists, and yield is 0.00%. Given current negative owner earnings and ongoing capital needs, initiating a payout would be imprudent. Expect total return from capital appreciation only, conditional on a credible and sustained cash flow turnaround. For Buffett investors, absence of a shareholder-oriented return policy is another reason to wait for proof. Source: Reuters Industry Outlook. The housing sector remains cyclical. Recent data show mortgage rates easing from prior highs, but recovery is uneven. Inventory pressures persist in many markets. Real estate tech adoption grows, yet competition for agents and transactions is intense. Macro sensitivity is high. A meaningful housing downturn or rate spike would compress transaction volume and revenues materially. The converse would help Fathom's top line. Source: Reuters Risks and Red Flags. Principal risks: persistent negative owner earnings and cash burn, housing cyclicality, shareholder dilution from frequent offerings, weak ROE, ROIC, thin moat versus larger tech-enabled brokerages, and financing reliance. Recent public offering activity underscores funding dependence. These are tangible execution and capital structure risks that materially affect survival and shareholder return outcomes if growth or margins disappoint. Sources: Yahoo Finance, Simply Walsane.